The market looks quiet, almost too quiet. On the charts, Bitcoin drifts sideways, Ethereum breathes between resistances, and traders scroll without conviction. Yet beneath that calm surface, liquidity is moving. Smart money, patient money, capital that remembers what the last cycle taught. And in that undercurrent, one name keeps flashing through data dashboards and Telegram threads alike. Aifeex, AFX. At $0.1173, it still looks small, so small that most algorithms ignore it. But size has never predicted momentum. Architecture does. And AFX's architecture has just entered a phase that economists call the scarcity shock. It begins with math, not hype. When Aifeex rewired its staking engine into the new AI-DeFi framework, it effectively created a deflationary corridor inside a growth environment. The one staking protocol, every AFX locked alongside USDT, reduced the circulating float more aggressively than any burn campaign could. It was the kind of technical shift that few outside developers noticed at first. Yet in the blockchain's ledger, the results were immediate. A visible tightening of liquidity, fewer AFX changing hands each week, and a measurable rise in wallet retention time. In human terms, people stopped trading and started holding. That's the first symptom of a scarcity shock. Zoom into a single user. They open the Aifeex app and see the numbers, their stake, their rewards, the slow daily release. They aren't gambling now. They're participating in a system that behaves like a machine-governed treasury. The interface feels calm, clinical. AI panels tracking yields, a voiceless intelligence predicting optimal compounding windows. But behind that stillness is design intent. The developers wanted AFX to feel stable while the economics quietly constricted supply. Stability at the surface, compression underneath. It's a psychological trap for traders, but a gift for holders. At $0.1173, the token sits near its lowest perceived risk point since the dApp migration. Whales know this pattern. They buy when charts look frozen, when retail is tired, when Twitter has moved on. They understand that once staking saturation passes a threshold, usually 70% of circulating supply, the next 10% locked creates disproportionate impact on price. The bid-ask curve stiffens, liquidity thins, and any volume surge translates into vertical movement. We saw it in 2021 with SushiSwap, in 2023 with GMX, and now, potentially, in 2025 with Aifeex. For the AFX community, the story isn't only price. It's evolution. The move from centralized dashboards to the AI-DeFi dApp didn't just decentralize assets, it decentralized trust. No VIP tiers, no referral hierarchies, no backend toggles. Just code, consensus, and transparent mathematics. That autonomy shifted psychology again. Users became stakeholders, and stakeholders became evangelists. Each referral removed became a symbolic statement. We don't sell influence, we share proof. And proof, on-chain, is immortal. The one model also introduced a behavior economists hadn't expected, mirrored conviction. When users stake AFX with USDT, they effectively pair faith with fiat. That pairing converts emotional belief into measurable collateral. The dollar anchors volatility, the AFX represents participation. Together, they behave like a miniature liquidity bond, a decentralized version of a savings certificate whose yield algorithm learns from every participant's actions. The more consistent the behavior, the more stable the return curve. That's how AI turns volatility into structure. Meanwhile, global AI tokens continue to set the narrative stage. Render, Fetch.ai, and SingularityNet have already normalized the idea that artificial intelligence can have a tokenized economy. Aifeex extends that logic to capital management itself. AI not just processing data, but allocating it. And when the market realizes that AFX sits at the intersection of machine autonomy and financial scarcity, the perception gap closes fast. Today it's $0.1173. Tomorrow it could be the case study every DeFi fund uses to explain adaptive scarcity mechanics. The quiet accumulation phase is the film's slow build, the sound of water rising before a dam break. Exchanges show thin order books. On-chain analytics reveal stealth wallet clustering. Telegram moderators start deleting, "Is this dead?" comments because the charts are flat, but the developers are still shipping. These are the moments long-term holders wait for. Because in crypto, disbelief is the best entry signal of all. Every market has a trigger point, the silent minute before motion, when the order books begin to breathe. For AFX, that trigger sits in data, not drama. The moment staking penetration crosses 70% of circulating supply, history shows a pattern. Volatility implodes, order depth evaporates, and the slightest influx of volume becomes kinetic. It's a physics problem disguised as finance. Right now, at $0.1173, AFX is flirting with that inflection. Analysts watching the on-chain dashboard have noticed the curve bending. New addresses join slower, but the total locked value keeps climbing. That divergence is the classic signal of network consolidation. The hands are changing, from traders to holders. In previous cycles, this phase felt like silence. Telegram slows down. YouTube thumbnails fade from red to gray. But the code is working. AI routines inside the dApp quietly rebalance yield rates, using historical liquidity heat maps to predict when the next surge might occur. In the background, millions of micro-adjustments reweight the staking algorithm. Humans sleep, the protocol learns. It's here that psychology turns technical. People don't notice supply shrinking until it touches price. In March, 5% of total AFX volume sat on exchange hot wallets. By June, that number dropped below 2%. This is what compression looks like. Coins migrating from tradable pools into contractual silence. Each unit staked removes 2, the AFX and its USDT partner, from open circulation. Multiply that by tens of thousands of participants, and a $10 million daily liquidity band becomes a $2 million corridor. That's why, when even modest demand returns, price doesn't rise gradually. It reprices instantly. Cinematically, picture it. An overhead shot of order books tightening, candles trembling as if the chart itself holds its breath. Voiceover. When circulation dries up, price doesn't climb, it escapes. The one staking system isn't just economic design, it's narrative design. It builds anticipation into the market's architecture. Every release of rewards counts down toward final scarcity, and every countdown builds the collective tension of the community. It's financial storytelling embedded in code. But scarcity alone doesn't create sustainability. That's where the AI-DeFi integration becomes crucial. Aifeex's neural risk modules run continuous simulations across pairs, measuring volatility decay and adjusting incentive coefficients. In simple terms, the smarter the system gets, the less it needs human correction. This is autonomy in motion, a network teaching itself how to balance greed and fear. As intelligence increases, inefficiency dies, and the surviving tokens represent pure participation value. Around the same time, global macro conditions feed the backdrop. Post-halving cycles push liquidity outward from Bitcoin. Traders hunt yield that feels safe yet scalable. AI tokens become the new narrative hub. Funds that rode the 2024 AI surge now rebalance toward DeFi applications, searching for projects that combine machine logic with verifiable cash flow. Aifeex ticks every box: capped supply, adaptive staking, transparent contracts, and measurable adoption. The equation is seductive. Limited tokens plus expanding demand equals pressure. The human side surfaces again. Communities matter in these transitions, and the AFX group has grown quieter, more deliberate. In Telegram chats, longtime holders share screenshots of their DApp dashboards like postcards from the future, slow releases, steady yields, and AI-generated insights predicting next month liquidity ranges. These aren't hype posts, they're progress logs. The tone is calm, analytical, almost journalistic. The culture itself has matured, mirroring the protocol it supports. Scarcity breeds seriousness. On the chart, weeks pass. Price hugs 11 cents, occasionally wicking to 12 cents or 13 cents, teasing movement but refusing confirmation. To outsiders, it looks stagnant. To data analysts, it's coiling. The Bollinger Bands narrow, volume shrinks, social mentions fade. That's how the compression phase ends, when impatience peaks. Then, one green candle cracks the stillness, thin at first, then longer, feeding on its own echo. In less than a day, price doubles. Exchanges lag, algorithms adjust, social media wakes up. The narrative resets from forgotten to how did we miss this? Behind that sudden motion are months of invisible mathematics. AI rebalancing, staking saturation, liquidity exhaustion. It's not magic, it's mechanized scarcity performing exactly as designed. As the chart ascends, analysts call it a breakout, insiders call it physics. And at $0.1173, everyone who understood scarcity before it was obvious finally sees proof of concept painted in green. Momentum changes tone. When an asset doubles from 11 cents to over 20 cents, narrative accelerates faster than the chart. Telegram becomes loud again. Ex-influencers suddenly remember they called it early, and retail traders rush to identify the next price level. But AFX's climb isn't built on hype cycles. It's built on math that's finally visible. The network's total locked value surpasses $100 million. AI modules report that 72% of circulating supply is now bound to 1:1 staking contracts, and only 18% remains actively tradable. The phrase that once felt like a metaphor, scarcity shock, now has on-chain proof. The dApp's analytics feed glows with motion. Each AI node broadcasts live staking telemetry, reward decay curves, liquidity density, cross-chain flow maps. It's the first DeFi interface that behaves like a trading terminal fused with an AI control room. Users watch yield data in real time, but what fascinates analysts most is the feedback loop. The AI doesn't just calculate, it adapts. When sudden inflows threaten imbalance, the model rebalances incentives before volatility even appears. That's not speculation. That's computation defending value. From a storytelling lens, this is where the camera pans wide. Across the AI token landscape, projects pivot to integrate utility. Render focuses on GPU markets. Fetched at AI pursues agent communication. SingularityNet evolves into data liquidity. Aifeex distinguishes itself by merging them all into finance. AI agents trading liquidity itself. The concept reshapes the conversation. Tokens are no longer just digital coupons. They're economic neurons feeding a collective intelligence that governs capital. Back in the chart room, investors recalibrate expectations. Analysts who once spoke cautiously now model aggressive but reasoned projections. $1 if AFX captures a fraction of the DeFi AI sector. $3 if staking saturation holds through 2026. $5 if multi-chain deployment succeeds. The visionaries still whisper about $10, not as hype, but as long-tail potential in a maturing ecosystem. The speculation is no longer wild. It's structured. Price targets are footnoted with metrics, not memes. The AI-DeFi engine itself becomes part of that analysis. Its learning curve parallels human conviction. Early adopters took risk when code was young. Now code reciprocates by protecting their liquidity. Algorithms detect exit anomalies, sudden mass unstaking, and adjust reward velocity to cushion impact. Every user action trains the model further. In essence, AFX's network becomes a learning organism, one that punishes greed but rewards patience. Meanwhile, exchanges start to compete for liquidity listings. Without naming names, Tier 1 platforms hint at pending integrations, and insiders notice liquidity test transfers between cold wallets. Listing means visibility, and visibility means psychology. The minute the ticker appears on a mainstream exchange, it graduates from experimental AI-DeFi to emerging infrastructure. Capital that once ignored AFX for low volume now sees it as an entry into a self-sustaining economy. The human emotion behind it deepens. Holders post screenshots showing yields converted into real utility, hardware purchases, rent, reinvestment. It feels less like speculation, more like participation in an evolving network that rewards time and consistency. The cinematic narration would frame this as the sunrise moment. After darkness and disbelief, the code begins to prove its promise. Yet even as optimism returns, caution lingers. True experts know that after every acceleration comes rebalancing. The AI itself predicts it. Market models forecast mini corrections, 20% drawdowns to clear leverage, temporary volatility before the next equilibrium. But these dips no longer scare the community, they invite it. Holders understand that every retrace releases weak hands and strengthens the scarcity curve. In long-form documentaries, this is the third act. The realization that patience is not passive, it's participatory. Outside the charts, mainstream media begins to notice. Financial journalists who once dismissed DeFi now request interviews about AI-powered liquidity economies. Academic conferences cite Aifeex's model as a case study in automated governance. What began as a small migration announcement has turned into a movement narrative, a network using artificial intelligence to enforce decentralization, not centralize it. By the time AFX retests 25 cents, the question is no longer if, but how high before exhaustion. On-chain data shows the 1:1 reward pool halfway depleted. The countdown has begun. Each block mined brings the system closer to total emission closure, the day when yield ends and scarcity becomes permanent. Economists watching that timer call it the Great Release. For participants, it's something else. The moment when AFX transitions from a token with rewards to a commodity with utility. The script's pacing now slows again, mirroring the deep breath before a finale. Narration softens. Every market cycle writes one truth in code. Scarcity creates focus. Focus creates value. And value, once recognized, rewrites perception. AFX has reached that threshold. But the final act isn't price, it's permanence. The silence that follows a rally is always deceptive. Charts flatten, volume cools, and new investors mistake calm for weakness. But within the Aifeex network, silence has a different meaning. It's equilibrium, a pause between epochs. The final emission blocks are nearing completion, the 30 million AFX reward pool dwindling line by line. What remains isn't a countdown to zero, but a countdown to self-sufficiency. After this, no new supply enters circulation. Every future transaction, every yield, every burn comes from real activity. AI agents trading, staking, and computing in the open market. The era of synthetic growth is over. What begins is organic evolution. Inside the dApp, a quiet transformation unfolds. The interface that once highlighted staking now pivots toward participation modules, liquidity routing, AI portfolio automation, cross-chain credit systems. The visual language changes too, soft blue hues replaced by deep gold tones, symbolizing maturity. Users no longer check APRs, they check performance analytics. They've evolved from yield farmers into data-driven financiers. It's the same community, but with a new consciousness. At $0.1173, the token that once seemed like a speculative whisper now acts like infrastructure. Developers build secondary tools around it, bots that read its smart contract logs, dashboards that predict reward release velocity, and even AI plugins that interpret staking data for retail users. In a sense, AFX has birthed its own economy of interpreters, each layer amplifying transparency. This self-referential ecosystem is what economists call reflexive utility, a product that increases in value because people are using it to understand itself. Global markets begin to notice. Research reports label Aifeex an autonomous liquidity protocol rather than a DeFi experiment. Institutional funds mention it in quarterly outlooks alongside larger AI tokens, citing its capped supply and adaptive governance as proof of resilience. A few forward-looking hedge funds quietly accumulate positions, not because they expect a pump, but because they understand what happens when supply ends and demand doesn't. It's the oldest economic story told in the newest technological language. The cinematic voice returns. Every market cycle begins with noise and ends with silence. Between them lies discovery. AFX has entered that silent phase again. The AI models continue learning, improving liquidity routing, reducing slippage, monitoring human behavior to detect collective emotion. It's as though the network has learned not only how to manage capital, but also how to interpret sentiment. If decentralized intelligence can feel anything, this would be awareness. Then speculation re-enters, not irrational, but visionary. Analysts start running long-horizon simulations. What happens when AFX becomes the collateral of choice for AI-driven trading agents? If each agent must stake AFX to operate safely, demand scales with automation itself. A 1% monthly increase in AI agents equals 1% monthly increase in required AFX. Compound that across years, and you have exponential scarcity chasing linear supply. The numbers suggest a plausible long-term valuation near $5, $10, not from hype, but from mechanical necessity. That's what people mean when they call this the intelligence economy. On-chain footage rolls, wallet clusters expanding, liquidity bridges glowing, and the burn counter ticking upward. The narrator lowers his voice. There are moments in technology when systems stop needing permission, when code governs capital without compromise. And when that happens, value stops being a question. It becomes a constant. Fade to black. The AFX logo gleams. Beneath it, the words, built on scarcity. Powered by AI.